BFM मॉड्यूले इंटरनेशनल बैंकिंग में हम लोग पढ़ेंगे 1. एक्सचेंज रेट्स एंड फॉरेक्स बिजनेस 2. बेसिक्स ऑफ फॉरेक्स डेरिवेटिव्स 3. कॉरेस्पॉन्डेंट बैंकिंग एंड NRI अकाउंट्स 4. डॉक्यूमेंट्री लेटर्स ऑफ क्रेडिट 5. फैसिलिटीज फॉर एक्सपोर्टर्स एंड इंपोर्टर्स 6. रिस्क्स इन फॉरेन ट्रेड रोल ऑफ ECGC 7. Role of Exim Bank, Reserve Bank of India, Exchange Control in India, FEMA and FEDI and others. The objective of this unit is to understand the definition and types of exchange rates, the mechanism and the markets, the factors affecting rates, the related guidelines, how a dealing room operates, Forex operations in India, various guidelines. Introduction. The world trade, export and import of commodities, cross-border movement of manpower and capital, travel and tourism and export of services, all necessitate the need for exchange of currency of one to the currency of another country. The export of goods manufactured in India to USA are paid in US dollars, where the exporter needs to convert the USD proceeds of the bill into Indian rupees. Similarly, import of capital goods from Germany into India, built in euro, is to be paid in euro by converting Indian rupees into euro. Thus, conversion of currencies from the currency of invoice to the home currency of the exporters will be generally required for all cross-border trades. This is foreign exchange. For the Indian exporter or the importer, the US dollars or euro is foreign exchange, while for the American buyer of Indian goods or the German seller of capital goods, Indian rupee is foreign exchange. Thus, in today's world, when nations push for greater inflow or outflow of goods, capital or services, foreign exchange has become an integral part of the world financial system. The term foreign exchange is more broadly used to denote foreign currency, that is currency of any country, as well as the exchange of currency of one country into that of another. Can we think of not exporting our surplus produces or not importing the new technology, machineries or consumables into India? Can we do without import of capital to fund our country's growth-related investments, travel, tourism, exports, imports of goods and services, repatriation of savings by expatriates? All depend on foreign exchange. Foreign exchange definition and markets. Foreign Exchange Management Act, FEMA, 1999, Section 2, defines foreign exchange as foreign exchange means foreign currency, and includes all deposits, credits and balances payable in foreign currency, and any drafts, travelers' checks, letters of credit and bills of exchange, expressed or drawn in Indian currency and payable in any foreign currency. Any instrument payable at the option of the drawee or holder thereof or any other party thereto, either in Indian currency or in foreign currency, or partly in one and partly in the other. Thus, broadly speaking, foreign exchange is all claims payable abroad, whether consisting of funds held in foreign currency with banks abroad or bills, checks payable abroad. In other words, a foreign exchange transaction is a contract to exchange funds in one currency for funds in another currency at an agreed rate and arranged basis. Exchange rates thus denote the price or the ratio or the value at which one currency is exchanged for another currency. The number of units of one currency, which are exchanged for a given number of units of another currency, is the exchange rate of the currency. For example, 1 US dollar is equal to 77 rupees or 1 euro is equal to 1.07 US dollar. The exchange rate is a dynamic rate, which varies from day to day, minute to minute and second to second, depending upon a variety of factors. We shall learn more about the Forex markets and other aspects as we go ahead. Foreign exchange markets. Foreign exchange markets comprise a large spectrum of market participants, which include individuals, business entities, commercial and investment banks, central banks, cross-border investors, arbitrageurs and speculators across the globe, who buy or sell currencies for their needs. It is a communication system-based market, with no boundaries, and operates round the clock, within a country and between countries. It is not bound by any walls or brick-and-mortar marketplace, which is a common feature for commodity markets, say vegetable market or fish market. It is a profit center with a simultaneous potential for losses. Forex markets are dynamic markets and work round the clock, in different time zones, in which various countries are located. Geographically, Forex markets extend from Tokyo and Sydney in the east, and operate through Hong Kong, Singapore, India, Bahrain, Frankfurt, London and New York in the west. If we view the markets as per GMT, when the London and other European markets start, the day it is almost lunchtime for the Indian markets, and when the Indian markets are about to close, the New York market is about to begin its day. Further, while the New York market operates for some time alongside the London and European markets, the markets in the East, Tokyo, Hong Kong and Singapore are ready to start before New York closes. The Indian and Middle East markets are ready to start the day before close of Singapore and Hong Kong markets. The world currency market is a very large market with a large number of participants. Major participants of Forex markets are central banks, managing their Forex reserves and using currency markets strives to reduce the volatility and smoothen out the value of their home currency. Commercial banks, offering exchange of currencies to their big and retail clients and hedging and investing their own assets and liabilities, as also on behalf of their clients, and also speculate on the exchange rate movements in the markets. Investment funds banks, moving funds from one country to another using exchange markets as a vehicle for investments as also hedging their investments in various countries, currencies. Forex brokers, acting as middleman between other participants, and at times taking positions on their books. Corporations, moving funds between different countries and currencies for investment or trade transactions or even speculation in currency markets. Individuals, ordinary or high net worth individuals using markets for their investment, trade, personal, and travel and tourism needs. As given here, the participants not only use the Forex markets for trade or travel purposes, but also for investments, hedging and speculative activities, thus generating large volumes for the market. It may be surprising to note that the global Forex market handles a total turnover of approximately $5.1 trillion, 5,100 billion per day, while the daily world trade turnover is approximately 2.00% of this Forex turnover. This means that around 98% of the global Forex trading relates to investments or speculative trading. The Indian Forex markets too trade over $34 billion per day, which is again a good multiple of the India's average daily export-import trade turnover, mostly because of regulatory exchange control regime and restrictive flow of foreign currency. The Forex markets are highly dynamic. On an average, the exchange rates of major currencies, say pound sterling to US dollar, fluctuate every 4 seconds, which effectively means it registers 21,600 changes in a day, 15 by 60 by 24. Now that means that you look aside for a moment and when you turn back for the rate, the same could have moved either way. Forex markets usually operate from Monday to Friday globally, except for the Middle East or other Islamic countries which function on Saturday and Sunday with restrictions to cater to the local needs, but are closed on Friday. The bulk of the Forex markets are OTC, over the counter, meaning that the trades are concluded through telephone or other electronic systems, dealing systems of various news agencies, banks, brokers or internet-based solutions. Banks in London quite commonly deal with banks in Paris, Frankfurt, Mumbai and New York and even in Tokyo or Singapore, which are totally in a different time zone. Large dealing rooms of global banks or corporates operate round the clock to be with all major markets across the globe. A few traders are provided dealing platforms in their homes to enable them to trade in any time zone. Now with the internet accessibility on the mobile and downloading the app of the market players, the forex markets can be accessed anytime, any place. Major banks, which act as market makers, offer two-way quotes, buy and sell, and leave upon the caller to either buy or sell as per his needs. This generates greater market depth and volumes. Thus the characteristics of foreign exchange market can be listed as under: a 24-hour market, an over-the-counter market as well exchange-driven market, a global market with no barriers, no specific location, a market that supports large capital and trade flows, highly liquid markets, high fluctuations in currency rates every seconds, settlements affected by time zone factor, markets affected by governmental policies and controls, factors determining exchange rates. The quotations in the forex markets depend on the delivery type of the foreign currencies, that is, exchange of streams of the two currencies being dealt with. The spot rates, being the base quotes in the forex markets, are more dynamic and are affected by varied reasons, a few of which are fundamental and other technical. The main factors, which influence movement of exchange rates, can be summarized as under: A. Fundamental reasons. These include all those causes or events which affect the basic economic and monetary policies of the concerned government. The causes normally affect the long-term exchange rates, while in the short run, many of these are found ineffective. In a long run, exchange rates of all currencies are linked to fundamentals, as given under: balance of payment. Generally, a surplus leads to a stronger home currency, while a deficit weakens the same. Economic growth rate. A high growth leads to a rise in imports and a fall in the value of home currency, and vice versa. Fiscal policy. An expansionary policy, for example, lower taxes, can lead to a higher economic growth. Monetary policy. The way a central bank attempts to influence and control interest and money supply can impact the value of currency of their country. Interest rates. High domestic interest rates tend to attract overseas capital, and thus the currency appreciates in the short term. In the longer term, however, high interest rates slow the economy down, thereby weakening the currency. Political issues. Political stability is likely to lead the economic stability, and hence a steady currency, while political instability would have the opposite effect. B. Technical reasons. Government controls can lead to an unrealistic value of a currency, resulting in violent movement in exchange rates. Freedom or restriction on capital movement can affect exchange rates to a larger extent. This is a phenomenon which was seen in Indonesia, Thailand, Philippines, Korea, etc. during the Southeast Asian currency crisis of 1997. Huge surpluses generated in the petroleum exporting countries, such as OPEC countries, due to the sudden spurt in petroleum prices, which could not be utilized in these countries, had to be invested overseas. This created huge movement of capital overseas and resultant appreciation of the currency for the country, which got the inflows of forex. Capital normally tends to move from lower yielding to higher yielding currencies, and results in movement in exchange rates. C. Speculation. Speculative forces can have a major effect on exchange rates. In an expectation that a currency will be devalued, the speculator will short sell the base currency, say dollar, for buying it back cheaper at a later date. This very act can lead to movements in the market, as the expectation for devaluation grows and extends to other market participants as well. Speculative deals provide depth and liquidity to the market and at times act as a cushion too, if the views do not lead to a contagious effect. Exchange rate mechanism. Types and calculation. Due to the vastness of the market, operating in different time zones, most of the forex deals are done on spot basis, meaning thereby that the delivery of the funds takes place on the second working day following the date of deal contract. The rate at which such deals are done is known as spot rates. Spot rates are the base rates for other FX rates. The date of delivery of funds on the date on which the exchange of currencies actually takes place is also referred to as value date or settlement date. The delivery of FX deals can be settled in one or more of the following ways: ready or cash. Settlement of funds takes place on the same day, date of deal. For example, if the date of ready cash deal is the 3rd of October 2016, Monday, settlement date will also be the 3rd of October 2016. Tom. Settlement of funds takes place on the next working day of the date of deal. For example, if the date of Tom deal the 3rd of October 2016, Monday, settlement date would be the 4th of October 2016, Tuesday, provided it is a working day for the markets dealing as well as where currency is to be settled. If Tuesday is a holiday in either of the two countries, the settlement date will be next common working day in both the countries. Intervening Saturdays and Sundays will also postpone the settlement date to next working day. Spot. Settlement of funds takes place on the second working day after following the date of contract deal. For example, if the date of spot deal is 3rd of October 2016, Monday, settlement date will be 5th of October 2016. Presuming all markets are working on 3, 4 and the 5th of October 2016. If not, it will the next working day in both the countries. Intervening Saturdays and Sundays will also postpone the settlement date to next working day. Forward. Delivery of funds takes place on any day after spot date. For example, if the date of forward deal is the 3rd of October 2016, Monday, for value settlement date the 30th of October 2016 or the 30th of November 2016, it is a forward deal. Spot and forward rates. As explained earlier, in the Forex market all rates quoted are generally spot rates. The spot rates are for delivery of currency or exchange of the streams of currencies dealt in on the second working day from the date of deal or transaction. Say US dollar to Indian rupee quoted as 1 US dollar equals 68.10 rupees, or pound sterling to US dollar quoted as 1 pound equals 1.2180 US dollars, or euro/USD as 1 euro 1.0580 US dollars. The volume, depth and volatility of the spot market is higher due to large participation of market players in the spot trades. On the other hand, when the delivery of the currencies is to take place at a date beyond the spot date, i.e., beyond 2 working days, then it is a forward transaction, and the rate applied is called forward rate, which is generally different from the spot rate. Let us now see why and how this is so. Forward margins, premium and discounts. Forward rates are derived from spot rates, and are function of the spot rates and forward premium or discount of the currency being quoted. Forward rate equals spot rate plus premium, or discount. If the forward value of the home currency is more than that being quoted for spot, then it is said to be at a premium, while if the home currency is cheaper on a forward date than spot, then it is called at a discount. To simplify, if the forward value of the currency is higher than, costlier, the spot, present, value, then the currency is said to be at a premium. Say, if the spot GBP against USD is being quoted at 1.2100, and 1 month forward as 1.2150, then GBP is dearer, value 1 month forward, and a premium of 50 pips, 0.0050, is being paid for the same. Similarly, if the forward value of a currency is cheaper than the present value, spot, the currency is said to be at a discount. In the above example, where the spot GBP is quoted as 1.2150 against USD, and 3 month forward as 1.1150, 100 pips, while the GBP is at a discount, the USD, the other currency, is at a premium against the GBP. Let us take another example. Indian rupee spot being quoted as 68.1011 against USD. $1 is being bought at 68.10 and sold at 68 rupees and 11 paise. Now if the 6-month premium being quoted is 68.69 paise, it means that the USD is being quoted dearer in forward and is being quoted as 68.7880. Here the USD is at a premium, while the INR at a discount, thereby meaning that the USD is costlier for future value, while the Indian rupee is cheaper for future value. Thus, a correlation is clearly established as the quotes are for a pair of currencies, where one is exchanged for another, pound sterling to US dollar to Indian rupee, US dollar to Singapore dollar, euro/USD, US dollar to Japanese yen, etc. The forward premium and discount are generally based on the interest rate differentials of the two currencies involved, as also on the demand and supply of forwards in the market. The demand and supply depends upon various factors, which include movement of capital in normal times as well as out of flight fear, flight of capital, status of exports and imports, trade balance as also balance of payment, other financial and fiscal status of countries, freedom to invest and move in and out, infrastructure and labor position, political stability and speculative activities, etc. In a perfect market, with no restrictions on finance and trade, the interest factor is the basic factor in arriving at the forward rate. If the rate of interest, say in the US, for 3 months prime bank bills is 2% PA while similar paper in London can be purchased at a rate of interest of 4% PA, there will be a flow of funds from USA to London to take advantage of higher yield shown by the UK bills. Assuming there are no exchange controls and free movement of capital is allowed, the US investor will have to buy GBP by surrendering his USD, owned or borrowed, in the spot market and the GBP so obtained by him would be invested in the UK bills. This will lead to a demand for GBP in the spot market. At the maturity of pound bills, the pounds received would be reconverted to US dollars. This will lead to a demand for USD in the forward. This gain or sacrifice will be adjusted in the forward rate of currencies, as forward margin, premium or discount, dealt in the foreign exchange market, to ensure a no profit, no loss situation. Therefore, the forward price of a currency against another can be worked out with the following factors. 1. Spot price of the currencies involved. 2. The interest rate differentials for the currencies. 3. The term, i.e., the future period for which these worked out. It would be relevant to emphasize here that the forward rates worked out is not a guarantee of the future trend of the currency values but only an expectation, direct and indirect quotes. As mentioned elsewhere, the price of the currency can be expressed either as one unit of home currency, equal to so many units of foreign currency, or as one unit of foreign currency equal to so many units of home currency. Under direct quotes, the local currency is variable, say as in India, $1 equals 68 rupees and 10 paise. The rates are called direct, as the rupee cost of foreign currency is known directly. These quotes are also called home currency or price quotations. On the other hand, under indirect method, the local currency remains fixed, while the number of units of foreign currency varies. For example, 100 rupees equals $1 and 47 cents. It would be worthwhile to mention that globally a practice is being followed where all currencies, except a few, are quoted as direct quotes, in terms of USD, $1 equals so many units of another currency. Only in case of GBP, Great Britain pound/British pound, Euro, odd, Australian dollars, and NZD, New Zealand dollars, the currencies are quoted as indirect rates, that is, 1 GBP, Euro, odd, or NZD equals so many units of USD. Cross rates. When we deal in a market where rates for a particular currency pair are not directly available, the price for the said currency pair is then obtained indirectly with the help of cross-rate mechanism. This can be explained with the following example. Suppose we intend to get a quote for Euro INR and no one is prepared to quote Euro INR directly in the market. We can work out a Euro INR quote through Euro USD and US dollar to Indian rupee quotes. Euro USD quote would be available in the international markets and US dollar to Indian rupee would be available in the domestic market. By crossing out USD in both the quotes, we can arrive at an effective Euro/Rs quote. This is the basis for working out cross rates. Cross-rate mechanism is a possible solution for calculation of rates for currency pairs which are not actively traded in the market. For example, we need to quote a GBP against INR, but in India, usually GBP is not quoted directly. As such, we need to take rates for US dollar to Indian rupee and pound sterling to US dollar to compute pound sterling to Indian rupee rate. If US dollar to Indian rupee is 68.1011 and pound sterling to US dollar is 1,2110, then, to pound sterling to Indian rupee rate, we need to multiply both the given rates, which would give us pound sterling to Indian rupee rate as 82 rupees and 40 paise 82.48. Or say if US dollar to Japanese yen is 116.5060, the rate for rupee JPY would be 58 rupees and 40 paise 46 per 100 Japanese yen, JPY being quoted per 100 units, due to their values, fixed versus floating rates. The fixed exchange rate is the official rate set by the monetary authorities for currencies. It is usually pegged to one or more currencies. Under floating exchange rate, the value of the currency is decided by supply and demand factors for that particular currency. In some cases, even fixed exchange rates are allowed to fluctuate between definite upper and lower bands, as fixed by the monetary authority of the country. Since 1973, the world economies have adopted floating exchange rate system. India switched to a floating exchange rate regime in 1993, from currency basket peg where currency fluctuations depended upon fluctuations in the basket of currencies. The composition of the currencies in the basket was decided upon on a trade weight basis, i.e., on the trade relationships between the countries whose currencies formed the basket. Bid and offer rates. The buying rates and selling rates are also referred to as bid and offer rates. In a US dollar to Indian rupee quote of 68.1011, the quoting bank is bidding for USD at 68.10 and is offering to sell the USD at 68.11. On the other hand, in a pound sterling to US dollar rate 1.210010, the quoting bank is willing to buy GBP at 1.2100 and willing to sell at 1.2110. Exchange arithmetic, theoretical overview. All foreign exchange calculations have to be worked out with extreme care and accuracy, and the decimal point has also to be correctly placed. Constant check is also required to minimize the risk of mistake, as the markets work on very thin margins. An error in one quote may erode earnings from several trade/transaction. Chain rule. It is used in attaining a comparison or ratio between two quantities linked together through another or other quantities and consists of a series of equations, commencing with a statement of the problem in the form of a query and continuing the equation in the form of a chain so that each equation must start in terms of the same currency as that which concluded the previous equation. Percent and per mille. A percentage, percent, is a proportion per 100. For example, 1% is 1 part in every 100 parts, such as rupee 1 per rupees 100, while per mille means per 1000. For example, 1 per mille is 1 part in every 1000, such as rupee 1 per rupees 1000. Percentage or per millage can also be used to one's advantage in checking roughly any calculations, such as interest when allowed in a rate of exchange. Value date. This is the term used to define the date on which a payment of funds or an entry to an account becomes actually effective and or subjected to interest, if any. In the case of payments on telegraphic transfers, TT, the value date is usually the same in both centers, i.e., payment of the respective currency in each center takes place on the same day, so that no gain or loss of interest accrues to either party. Such payments are said to be value occupancy, or, simply, here and there. If there is time lag between receipt of funds at one center and payment of funds at another center, compensation should be paid to party, which is out of funds. Normal mode of compensation is interest, which should be recovered or paid separately. This may be done by adjusting the value date if acceptable to both the parties. Thus, the date of settlement of funds is known as value date. Arbitrage in exchange. Arbitrages consist of the simultaneous buying and selling of a commodity or currency in two or more markets to take advantage of temporary discrepancies in prices. As applied to dealings in foreign exchange, arbitrage consists of the purchase of one currency for another in one center, accompanied by an almost immediate sale against the same currency in another center, or in operations conducted through three or more centers and involving several currencies. A transaction conducted between two centers only is known as simple or direct arbitrage. Where additional centers are involved, the operation is known as compound or three or more point arbitrage. Such operations must be carried out with the minimum time delay if advantage is to be taken of temporary price differences, and they require a high degree of technical skill. Speed in handling the deals would be the foremost aspect in such deals, as markets usually tend to move towards such deals and the differences get wiped out in no time. Rates quoted to merchants, or for retail transactions are specified by the nature of transactions. By this, the different rates could be applied for TT, bill transactions, foreign money or cash transactions, traveler's checks transactions, or even personal checks buying. The rates would be different for buying or selling transaction, levying different margins over the interbank rates, depending upon the nature of transaction. Foreign exchange dealing room operations. The Forex dealing room operations comprise functions of a service branch to meet the requirements of customers of other branches' divisions to buy or sell foreign currency, manage foreign currency assets and all liabilities, fund and manage nostro accounts as also undertake proprietary trading in currencies. It acts as a separate profit center for the bank or institution. The dealers, who are actually involved in the buying and selling of currencies, or undertaking market activities are the most critical manpower, as their understanding of the job, risk-taking capacity and speed in decision-making, all may lead to generating profits for the dealing operations. On the other hand, a small mistake or a misjudgment may wipe off the entire day's profit in a second. A good dealer needs to have a good understanding of the changing nature of things. Certain psychological qualities are prerequisites. The ability to work under stress, willingness to accept responsibilities, the ability to make decisions quickly, a good measure of aggressiveness and above all, a willingness to recognize that one can be wrong. There must exist an atmosphere of complete trust within a dealing room. A dealer has to maintain two positions: funds position and currency position. The funds position reflects the inflow and outflow of funds. That is, receivables and payables. Any mismatches in the receivables and payables will throw open interest rate risks, in the form of a possible overdraft interest in nostro accounts or loss of interest income on surplus credit balances. It is very important for a dealer to properly maintain the funds position and manage the funds. The currency position, on the other hand, deals with the overbought or oversold positions, arrived after taking various merchant or interbank transactions, and the dealer will be concerned with the overall net position, which exposes the dealer to exchange risks from market movements. The dealer has to operate within the permitted limits prescribed for the exchange position by the management. The fund's position comprises of items that are ready in nature, affecting fund's position immediately, as also those in the nature of forwards, which affect fund's position at a later date. Thus, the dealer also needs to manage gap positions in different currencies. The other part of the dealing room is back office, which takes care of processing of deals, accounts, reconciliation, etc. This function is of the equal importance. Any laxity in this area would also land the institution into unforeseen trouble. Either, it may negate the efforts of the dealers to generate profits, or it could be so lax that the dealers exploit the situation and indulge in misreporting or wrongdoings, without the notice of the back office. Hence, back office has both a supportive as well as a checking role over the dealer's dealing room. Foreign exchange dealing room operations. The Forex dealing room operations comprise functions of a service branch to meet the requirements of customers of other branches' divisions to buy or sell foreign currency, manage foreign currency assets and or liabilities, fund and manage nostro accounts, as also undertake proprietary trading in currencies. It acts as a separate profit center for the bank or institution. The dealers, who are actually involved in the buying and selling of currencies, or undertaking market activities, are the most critical manpower, as their understanding of the job, risk-taking capacity and speed in decision-making, all may lead to generating profits for the dealing operations. On the other hand, a small mistake or a misjudgment may wipe off the entire day's profit in a second. A good dealer needs to have a good understanding of the changing nature of things. Certain psychological qualities are prerequisites. The ability to work under stress, willingness to accept responsibilities, the ability to make decisions quickly, a good measure of aggressiveness, and above all, a willingness to recognize that one can be wrong. There must exist an atmosphere of complete trust within a dealing room. A dealer has to maintain two positions: funds position and currency position. The funds position reflects the inflow and outflow of funds. That is, receivables and payables. Any mismatches in the receivables and payables will throw open interest rate risks, in the form of a possible overdraft interest in nostro accounts or loss of interest income on surplus credit balances. It is very important for a dealer to properly maintain the funds position and manage the funds. The currency position, on the other hand, deals with the overbought or oversold positions, arrived after taking various merchant or interbank transactions, and the dealer will be concerned with the overall net position, which exposes the dealer to exchange risks from market movements. The dealer has to operate within the permitted limits prescribed for the exchange position by the management. The funds position comprises of items that are ready in nature, affecting funds position immediately, as also those in the nature of forwards, which affect funds position at a later date. Thus, the dealer also needs to manage gap positions in different currencies. The other part of the dealing room is back office, which takes care of processing of deals, accounts, reconciliation, etc. This function is of the equal importance. Any laxity in this area would also land the institution into unforeseen trouble. Either, it may negate the efforts of the dealers to generate profits, or it could be so lax that the dealers exploit the situation and indulge in misreporting or wrongdoings, without the notice of the back office. Hence, back office has both a supportive as well as a checking role over the dealer's dealing room. The third part is mid-office, which deals with the risk management and parameterization of risks for the dealing room operations, including Forex transactions. It acts as a check over the risk taken by the dealers, as also supplements them by giving market information. Mid-office is also supposed to look after the compliance of various guidelines or instructions and is an independent function. With the increasing volume of foreign exchange transactions arising out of expanding international trade, both in goods and services, cross-border flow of money, and also because of the authorized dealers undertaking foreign exchange trading, the necessity for exercising management control over profit or loss valuation and adhering to the prescribed guidelines or limits needs no emphasis. Reserve Bank of India has approved the guidelines on Uniform Standard Accounting Procedure for valuation of foreign exchange profits and losses by authorized dealers, issued by Foreign Exchange Dealers Association of India, FEDI, which require banks to undertake profit-loss valuation of forex positions at the end of each month, notwithstanding the practice of passing accounting entries at quarterly intervals. However, the mechanization of dealing operations facilitates profit evaluation exercise at lesser frequencies as well, and in some organizations on daily basis. As per extant guidelines, each foreign currency position covering all components of foreign currency, exchange, position, viz., mirror accounts of the currency, foreign currency notes held, import suspense account, all spot and forward positions, including export bills, both sight and use-ins, transactions which are reported to the position desk but not adjusted in the accounts, that is, actual vouchers not put through, overdue contracts, interbank, if any liabilities should be revalued separately, and merchant contracts, and other foreign currency assets and liabilities should be revalued separately. Foreign Exchange Dealers Association of India advises the valuation rates based on ongoing market rates on month-end dates, to enable the authorized dealers to revalue their foreign currency positions. Management and control of a dealing room. Reserve Bank of India has advised that the board of directors of banks should frame an appropriate policy and fix suitable limits for its forex dealing functions. The management of dealing room operations should focus on risk associated with foreign exchange dealing room operations, which arise due to complex nature of foreign exchange markets and the volatile nature of exchange rate movements. The major risks associated with foreign exchange dealing operations, where the management needs to frame policies and keep a constant vigil, can be summarized as under. Operational risk. It is a risk arising on account of human errors, technical faults, infrastructure breakdown, faulty systems and procedures or lack of internal controls. Exchange risk. It is the most common and obvious risk in foreign exchange dealing operations and arise mainly on account of fluctuations in exchange rates and or when mismatches occur in assets, liabilities and receivables payables. Credit risk. It is a risk of loss which arises due to inability or unwillingness of the counterparty to meet the obligations at maturity of the underlying transaction. Credit risk is further classified into pre-settlement risk and settlement risk. Pre-settlement risk is the risk of failure of the counterparty before maturity of the contract, thereby exposing the other party to cover the transaction at the ongoing market rates with new counterparty. Settlement risk is the risk of failure of the counterparty during the course of settlement, due to the time zone differences between the two currencies to be exchanged. That is, where one party performs its part of the contract by delivering the currency to be delivered by it, but the counterparty fails before delivering the currency to be delivered by it, in a different time zone. The best example for this risk is the Herstatt risk, which arose due to the failure of a German bank Bankhaus Herstatt in Frankfurt in the year 1974. Liquidity risk. Liquidity risk is the potential for liabilities to drain for a bank at a faster rate than assets. The mismatches in the maturity patterns of assets and liabilities give rise to liquidity risk. Thus, it is a risk which may arise due to a party to foreign exchange transaction unable to meet its funding requirements or execute a transaction at a reasonable price on the maturity or due date. Gap risk/interest rate risk. In the course of its business, a bank buys and sells currencies for spot and forward value. It may not be always possible for the bank to match its forward purchase and sales. Thus, if the purchase and sale take place for different value date, while the bank may completely stand hedged on exchange front, it creates a mismatch at a future date between its assets and liabilities, which is referred to as gap. These gaps are to be plugged by the bank by paying or receiving appropriate forward differentials. These forward differentials are in turn a function of interest rates, and any adverse movement in interest rates would result in adverse movement of forward differentials, thus affecting the cash flows on the underlying open gaps or mismatches. Market risk, the risk that arises due to adverse movement of market variables, for example, exchange rates and interest rates, when the players are unable to exit the positions quickly. Legal risk, it is the risk arising on account of non-enforceability of contract against a counterparty. Systemic risk, this risk is the possibility of a major bank failing and the resultant losses to counterparties reverberating into a banking crisis. Country risk, it is the risk of counterparty situated in a different country unable to perform its part of the contractual obligations despite its willingness to do so due to local government regulations or political or economic instability in that country. Sovereign risk, it is a sub-risk in the overall country risk in that certain state-owned entities themselves quoting their sovereign status claim immunity from any recovery proceedings or fulfillment of any obligations they had originally agreed to. As in these countries, the sovereign status cannot be questioned even in a court of law. A comprehensive and accurate management control of dealing room operations would cover assessment of the above risk exposures and their management. It is to be noted that foreign exchange dealing room operations are considered to be profit centers in most of the banks, and a comprehensive risk management policy will only help the management to work within the permitted loss limits. To generate profits, it is essential to have a proper risk appetite to optimize profit through proper risk-reward trade-off. Details about these risks and their management and control would be covered under the unit on risk management. Foreign exchange dealing operation is a highly specialized function and has to be performed by well-trained personnel. Typically, a dealing room should consist of dealing and back-office staff. The back-office staff are responsible for the follow-up of deals put through by the dealers. The need for effective control over dealing room operations is of great importance, as possibilities exist for manipulation of exchange rates, dealing positions, washing names, mismatches, etc. A supreme principle of operational procedures and the area of dealing room activities is a clear functional separation of dealing, back-office accounting, processing and control, and reconciliation. The above details on the dealing room and its operations make it clear that the operations are crucial and important to any bank or institution. The contribution of exchange profit from merchant transaction as well as trading operations has its own place in the bottom line of the bank, as such large players in major markets have deployed a large number of dealers and other staff, supported by sophisticated communication and IT systems with huge investments, to handle the Forex dealing operations. These large dealing rooms have separate desks for traders, as also for derivatives, each of which specializes in its own product, and are constantly in the market to make money for the bank. In India too, a number of banks have large dealing rooms, and have grown to cater to various products, as permitted by Reserve Bank of India. RBI/PDI Guidelines. The Reserve Bank of India, being the central bank of the country and the custodian of nation's foreign exchange reserves, has prescribed guidelines for authorized dealers, permitted by it, to deal in foreign exchange and handle foreign currency transactions. FEMA 1999 also prescribes rules for persons, corporates, etc., in handling foreign currencies, as also transactions denominated therein. The Reserve Bank of India issues authorized dealers AD licenses to banks and all India financial institutions to undertake foreign exchange transactions in India. At present there are over 90 ADs, which include all public sector banks, foreign and a large number of private banks, a few all India financial institutions and a few scheduled cooperative banks. The RBI also issues money changer licenses to a large number of established firms, companies, hotels, shops, etc., to deal in foreign currency notes, coins and travelers' checks, to facilitate encashment of foreign currency for foreign tourists. Entities authorized to buy and sell foreign currency notes, coins and travelers' checks are called full-fledged money changers, FFMCs, while those authorized only to buy are called restricted money changers, RMCs. Categorization of authorized dealers. In the year 2005, the categorization of dealers authorized to deal in foreign exchange has been changed by the Reserve Bank of India. Now, the entities so authorized are called as authorized persons, with category, denoting their level of authority to undertake variety of transaction, as under authorized person, category I, authorized dealer banks, financial institutions, and other entities allowed to handle all types of foreign exchange transactions, earlier known as authorized dealers. Authorized person, category 2, money changers, allowed to undertake sale/purchase of foreign currency notes, travelers' checks, as also handle foreign exchange transactions relating to remittance facilities allowed to residents, like travel abroad, studies abroad, medical needs, gifts, donations, etc., earlier known as full-fledged money changers FFMCs. Authorized person, category 3, entities allowed to undertake only purchase of foreign currency notes and travelers' checks, earlier these entities known as restricted money changers RMCs. Foreign exchange operations, undertaken without any boundaries or controls, can adversely affect the movement of exchange rates and the value of currency, besides profitability of the entity dealing in an arrogant manner. Hence, RBI has prescribed broad guidelines with regard to foreign exchange operations in order to have regulated and disciplined market operations. RBI guidelines include those related to open positions, gaps, borrowing and lending in foreign currencies, interbank dealings in India and overseas markets, hedging of bank's own exposures as well as that of its resident and non-resident clients. Foreign Exchange Dealers Association of India, FEDI, on the other hand, is a non-profit making body, formed in 1958 with the approval of Reserve Bank of India, consisting of authorized dealers as members. FEDI prescribes guidelines and rules for market operations, merchant rates, quotations, delivery dates, holidays, interest on defaults, etc. in terms of RBI directives. All authorized dealers are members of FEDI and it is mandatory for them to follow the guidelines/directives issued by FEDAL. FEDI guidelines also prescribe rules related to handling of export-import bills, transit period, crystallization of bills and other related issues. It also advises RBI on market-related issues and supplements the efforts of RBI to strengthen the foreign exchange market in the country. A few of the major FEDI guidelines/rules can be summarized as under 1. All export bills to be allowed standard transit period, NTP, normal transit period, as prescribed, for the purpose of allowing concessional interest rates and calculation of notional due dates. 2. Export bills drawn in foreign currency, purchased discounted or negotiated, must be crystallized into rupee liability, in case of delay in realization of export bills. The same would be done at TT selling rate. The prescription of crystallization of export bills on the 30th day from the due date or notional due date has since been relaxed. Authorized dealer banks should formulate their own policy for crystallization of foreign currency liability into rupee liability. The policy in this regard should be transparently available to the customers. 3. Unpaid foreign currency import bills drawn under letters of credit shall be crystallized as per the stated policy of the bank in this respect. 4. All forward contracts must be for a definite amount and period with specific delivery dates. 5. Option period can be specified by the customer, in case of forward contracts, but in any case the delivery period under the contract shall not exceed beyond 1 month. All such contracts must state the start and end dates. 6. Cancellation of forward contracts. All contracts, which have matured and have not been picked up, shall be automatically cancelled on the 3rd working day, after the maturity date. 7. All cancellations shall be at bank's opposite TT rates, TT selling rate for purchase contracts and TT buying rate for sale contracts. 8. In the event of delay in payment of interbank foreign currency funds, interest at 2% above the prime rate of the currency of the specified banks shall be paid by the defaulting bank. 9. In the event of delay in payment of rupee settlement funds, interest for delayed period at 2% above the NSE MIBOR ruling on each day shall be paid. 10. All currencies to be quoted as per unit of foreign currency equals INR, while JPY, Indonesian rupiah and Kenyan shilling are to be quoted as 100 units of foreign currency INR. 11. PAYDAI also prescribes code of conduct for Forex dealers, as also guidelines with regard to dealings with Forex brokers. Let us also see some of the RBI guidelines, applicable to authorized persons, with regard to their operations and risk management of their own assets/liabilities and products that can be offered to clients. A. Caiib banks are allowed to open/close rupee accounts, non-interest bearing, in the names of their overseas branches or correspondents, except Pakistani banks operating outside Pakistan, without prior reference to RBI. B. Opening of rupee accounts in the name of exchange houses for facilitating private remittances through exchange houses requires prior approval of RBI. C. Caiib banks are allowed to open/close foreign currency accounts abroad to route foreign exchange transactions handled by them. Banks are also allowed to maintain balances in these accounts, as approved by their board. D. Caiib banks are free to undertake investments in overseas markets in money market instruments and/or debt instruments, issued by foreign state with a residual maturity of less than 1 year and rated as per guidelines. E. Surplus funds in nostro accounts can be utilized for granting loans to resident constituents for meeting their foreign exchange or rupee working capital or capital expenditure needs, extending credit facilities to wholly owned subsidiaries or joint ventures of Indian companies abroad, subject to terms and conditions. F. Loans or overdrafts. All borrowings of banks, including ECB, and temporary overdrafts in nostro accounts not adjusted within 5 days, shall not exceed 50% of their unimpaired Tier 1 capital or $10 million, whichever is higher. Overseas borrowings for the purpose of extending export credit in foreign currency, Tier 2 capital placed by foreign banks' head offices with their Indian branches and capital funds raised by issue if perpetual instruments or debt capital instruments shall not be a part of the above ceiling for raising foreign currency funds. G. Banks can allow residents to book forward exchange contracts to hedge their exchange risk exposure in respect of a transaction for which sale or purchase of foreign exchange is permissible under the FEMA 1999. H. Banks should satisfy themselves about the genuineness of the underlying documentary evidence and exposure, irrespective of the transaction being current or capital account in nature. The particulars of the forward contract booked should be marked on the documents, and copies retained thereof for verification. It must be ensured that the maturity of the contract must not exceed the tenor of the underlying. I. Banks can allow their importer and exporter customers to book forward contract on the basis of a declaration of an exposure and based on past performance up to an average of the previous 3 financial years, April to March. Actual import-export turnover or previous year's actual turnover, whichever is higher, subject to certain conditions. J. Similarly, small and medium enterprises, SME, can book forward contracts to hedge their direct or indirect exposures, without production of the underlying, subject to the condition that the SME enjoys credit facilities with the bank with which it desires to book the forward contract, and the quantum of forward contracts is in alignment with the credit facilities availed by it, and certain other conditions, as specified. K. Banks can also allow resident individuals, who are banking with them, to book forward contracts up to a limit of $100,000, with the condition that contracts booked under this facility will normally be on deliverable basis, The notional value should not exceed $100,000, and the forward contract may be booked for tenors up to 1 year only. L. Banks are also allowed to offer other derivative contracts, such as interest rate swap or coupon swap or foreign currency option or interest rate cap or collar or forward rate agreement contract, to resident entities who have borrowed foreign exchange in accordance with the provisions of FEMA 1999. These offerings and cover thereof shall be subject to certain conditions as specified. M. Bank can also offer foreign currency, rupee swap to resident persons that has a foreign exchange or a rupee liability to hedge long-term exposure, with certain conditions. N. Banks can enter into cross-currency options with their customers on back-to-back basis, subject to certain conditions. 0. Banks can also enter into foreign currency, rupee options with their customers on back-to-back basis. They can also run a book for this product, subject to RBI permission. Summary of the unit. Foreign exchange markets play an important role in the global economy. It is a 24-hour and over-the-counter market, with different type of players. The market operates on a professional basis and helps in developing not only the Forex markets but also the world trade and flow of funds. Being part of the global market, the Indian foreign exchange market is no exception, and has developed fine market practices over the years, in line with the ongoing liberalization, privatization and globalization, LPG process, initiated in India. The working of Forex markets across all time zones and its sheer size, lays emphasis on the importance of the dealing room operations, its organization, management and control. Following the prescribed guidelines and parameters would help in development of an orderly market as also growth of the dealing functions for an institution. Keywords used in this unit. Foreign exchange, exchange of one currency into another or foreign currency. Rate of exchange, the price of one currency in terms of another or a simple arithmetic expression of value of one currency in terms of another currency. Foreign exchange market, the market where foreign currencies are dealt with. OTC market, over-the-counter market. Authorized persons, banks/institutions/money changers authorized to deal in foreign exchange. Value date, the date of settlement of funds. Cross rate, price of a currency pair, not directly quoted, arrived from price of two other currency pain FEDI, Foreign Exchange Dealers Association of India. Forward contract, it is a binding contract for purchase or sale at a future date. Premium/discount, it represents interest rate differential in a forward contract. Premium, a currency is said to be at a premium if it commands more units of another currency or future date. Discount, a currency is said to be at a discount if it commands less units of another currency at a future date. Swap, it is an exchange of specific streams of payments over an agreed period of time. Floating exchange rate, market exchange rate decided by supply and demand factors. Direct exchange rate, exchange rate expressed in terms of home currency quotations. Indirect exchange rate, exchange rate expressed in terms of foreign currency quotations. Ready cash rate, value to be settled on the same day, value today. Term rate, value to be settled tomorrow, next day. Spot rate, value to be settled on the second working day from the date of transaction. Forward rate, value to be settled beyond spot value. Foreign exchange risk, risk that a bank may suffer losses as a result of adverse exchange rate movements during a period in which it has an open position in an individual foreign currency. Transaction exposure, transaction exposure measures the risk involved due to change in the foreign exchange rate between the time the transaction is executed and the time it is settled. Translation exposure, this exposure relates to valuation of foreign currency assets and liabilities at the end of accounting year at current realizable values. Operating economic exposure. Operating exposure is a measure of sensitivity of future cash flows and profits of a bank to unanticipated exchange rate changes. Open position. The extent to which assets and outstanding contracts to purchase a currency exceed liabilities plus outstanding contracts to sell that currency and vice versa. Overnight position. A limit on the maximum open position left overnight in all major currencies. Daylight position. A limit on the maximum open position in all major currencies at any point of time during the day. Such limits are generally larger than the overnight position. Options. A foreign exchange option is a contract for future delivery of a currency in exchange for another where the holder of the option has the right, without an obligation, to buy or sell the currency at an agreed price, the strike or exercise price, on a specified future date. Call option, the right to buy under the option. Put option, the right to sell under the option. Futures. Futures are forward contracts with a standard size, standard maturity date governed by a set of guidelines stipulated by the exchange concern for settlement and payments. Currency swaps. When two counterparties agree to exchange specific amounts of two different currencies at the outset and repay these over time in installments, reflecting interest and principal. Interest rate swaps. When interest payment streams of different character are periodically exchanged between the contracting parties,